Okay, big sell-off today, and the market breaking important levels. Sense of sort of resignation as far as investors are concerned. Good bounce from the day's low, but still deeply in the red. We are trying to understand what you should be doing next. Nilesh Shah is managing director at Kotak Mahindra AMC, and he's been answering questions. Nilesh, thank you for waiting. We lost you there. You were telling us pockets in the market which you feel are ripe for stock picking. You were talking about pharma as a space. Go on.
We are looking to add in pharma sector, industrial and capital.
Okay, I think we have lost the line with Nilesh. Some issues. We'll try and fix that. But I think we have Jeff Chowdhry of RLC Ventures, who's now with us. Jeff, great to have you with us here. Thank you very much for being with us here on CNBC TV18. Big fall, and it's starting to develop into a bit of a global drawdown. What is your assessment? Are we in the midst of a bit of a regime change from very easy liquidity, accommodative central bank policies, a generally reflationary kind of environment? And how would you characterize this pullback, this fall that we've seen so far?
Good afternoon, and thanks for having me on the show again. I appreciate it. Maybe I could just give you a little bit of context. About 4 to 6 weeks ago, I came onto your program, and there was a very nice debate with one of your other guests. And I was saying at that point in time that we are in the start of a fairly significant correction in markets globally, and indeed in India. And the issue so perversely, it's not related to COVID. Obviously, that's causing us a few headaches for us all, and some effects on the stock market. It's much more about the big picture and where we are in terms of the cycle. And the issue is a very simple one for me, is that we've had a number of years of easy money. We've had a number of years where the stock market has gone up, and we're now at a point where effectively that easy money is being taken away. Interest rates are going up, and you've got a situation that despite the recent correction, valuations are still very, very high. So I think people should tend to forget about the fact that, is this a trading bounce? Should we buy the dip, et cetera, and look back and say, right, we have a situation now where we're in a fairly significant correction. And in my opinion, we are not by any means through that correction at this point in time.
Jeff, good evening. Thanks a lot for joining us. There was one view in the market. Of course, prices can change opinion until about 3 or 4 weeks back that the markets can go up despite the tapering and despite the rate hikes like they did in 2003 to 7 phase. Do you think that thesis could still play out?
I think what we can see is that there will be short-term, very short-term corrections in the market, and there'll be big bounces in the market as a result of that. And the short-term corrections will be ones like that we're seeing now at the moment, where the Omicron variant and lockdowns will basically take markets down, maybe 5, 6, 7%. And then short-term traders will come in and say, right, okay, this is very cheap, let's go. But let's look at the big picture. The big picture is the following, is effectively these bounces should be sold because interest rates are going up, valuations are very, very high. And in that environment, you actually want to have very low element of equities in your portfolio. The other issue, which I'm afraid is going to be more of a problem I see, is that the Indian rupee is going to continue to go depreciate, which will be good for some sectors, obviously like the tech sector. But for the vast majority of the economy, it's not going to be good. And also, it'll make FIIs very, very cautious.
Jeff, what happens if the fact that rates are going up, right? I mean, that there is because of growth worries incrementally, because of COVID restrictions and such, there is again, I mean, a more benign attitude towards inflation. That we'll tolerate it as long as we want growth to be strong. That's been the message since the global financial crisis, really. Or are you saying, well, there is a hard turn now which is happening, will happen, and why?
Yeah, I think there's a couple of issues here. And I think the first thing is that in the past, central banks were quite happy for inflation to gradually tick up to 1-2%. But now we're in a situation where even in the sort of the Western markets, we're looking at inflation rates of about 5%. For example, in the UK, they're at 5% now. In that scenario, and obviously the Bank of England have recently raised rates, they can't stand by and watch inflation get out of control. So they're caught in a sort of in a dilemma. Do they increase interest rates because of the worry that inflation is going to start going up even towards double digits, or do they cut back on the growth? Now, in the past, there hasn't been an inflation issue, so they haven't had that dilemma. So they've had very, very easy money. Now it's a much more difficult scenario for them that they have to start edging rates up, despite the COVID and despite the fact that obviously economic growth may be affected. And that's why, from a stock market perspective, that's a very cautious environment that one is in at this point in time.
Okay.
I'll just add one other point. I do get asked a lot about the difference between India and China, and it's not an economic one, and it's not whether one is better than the other, or one is stronger than the other. The key difference is that the Chinese stock market is largely driven by domestic investors, and we could say sort of in an interesting sort of way that to some extent is controlled by the government. In the case of the Indian stock market, a lot of it, the incremental money is FII. So that's why it's so significant what's going on globally and interest rates.
Okay, before we thank you, in fact, that was my next question, but since you already preempted that, let me revise it. Where would India rank in the pecking order for you in emerging markets?
Pretty near the bottom, I'm afraid, for a couple of things. I mean, I would say I wouldn't put India in the basket case countries, and the basket case countries, no disrespect, are basically Turkey, South Africa, and Brazil. So let's exclude those ones. But if you look at the sort of the mainstream emerging markets, and obviously that would be China, South Korea, Indonesia, some of the Asian markets as well, I'm afraid towards the bottom. And the reason why I would say it's towards the bottom is essentially for two things. One is FIIs are so significant in terms of this market, and they will continue to be sellers, in my opinion. And secondly, as a result of that, and because of valuations unfortunately in India are very high.
Well, absolutely no disrespect at all, Jeff, and you have to say what you see. Thanks a lot for joining us. Have a good evening.
My pleasure.
Okay, well, that's a wrap on this edition of Market Sell-Off. We'll leave you with some market opinion that we got through the day.
I'm not surprised by this in some senses. Eventually valuations, as we've been saying for a while, have been quite rich. You never quite know what it is which then causes the markets to correct. I've been in the markets for 30 years now, and a 10% fall from a recent high is nothing unusual. In fact, what is unusual is that if it doesn't happen, in any given 12 to 24 month period. Very interestingly, Lata, the market has not had a 10% setback going all the way to, I think, somewhere around May of 2020. So it's been 1.5 years since we've seen a 10% cut in the market.
I'm not sure that the market's that yet. Some of the froth that we see in some of the more speculative names is not completely out yet. So for us, a sign of whether the market has corrected is when we see maybe a little more hawkish talk from the RBI, maybe a little bit more froth coming out from some of the frothy names. So we're cautiously buying, but we're being patient. We're not rushing in. Because you've seen the FI data. I mean, we've been saying this for months that FIs are concerned about the rupee and about risks there, and the rupee has bled lower